hello and welcome to our final webinar of 2024. We've had a series of webinars around creating a sustainable family business, and today we're going to start looking forward to the new year, so to 2025, and examining the impact of the recent budget and how it's really sort of changed the view of a lot of families and their businesses, I think, and what's needed to move forward successfully in 2025. My name is Sylvia Vitiello. I'm a partner in Moore Kingston Smith and the head of our family business group. The panel of family business experts with me today includes some familiar faces, and for those of you that have actually watched our series before. So I'm starting with Rob Edwards, who's our senior financial advisor with Moore Kingston Smith Financial Services. Yvette Jacobs-Lee, who's our tax partner in the family business and entrepreneurial tax group. And finally, last but not least, Guy Sterling is our tax partner in the private client tax team. Now, since our last webinar, as I said, a great deal has changed. We have a new government and, of course, that budget that followed. All budgets ripple change through families and business finances. But this last one has, from our new Chancellor, has been more of a seismic shift, I think, for some areas. And there's a lot of planning to do and expectations for more to come. I think the devil will be in the detail, as our tax team will tell us a bit as we're talking through this. It's a huge subject. So I think there's a lot to cover in today's webinar, but our panel are going to concentrate on three main areas. They're very important to families and family businesses. And they're going to be looking at taxing family wealth, profitability within the business itself, and investing and exit strategies for families. I've made sure I've included the correct titles for those. Now, if you have any questions as we go through, just drop them into the chat function at the bottom, and I will pick them up as we're going along, and we will cover off on any of those questions that we can right at the very end. But right now, as I said, there's a lot to cover, so I'm going to be quiet for a while and make a start by turning first to Yvette. Now, Yvette's going to talk us through some of her thoughts regarding the taxation of family wealth, where we were, and where the individuals and their businesses are finding themselves today following that budget. So I'm going to hand over to you, Yvette. Do talk us through.
Great. Thanks, Sylvia, and hello, everybody. Pleased to be here and having the chance to talk through some of these hot tax topics today. So I'm going to talk about the really big change for family business in the budget, and that's around inheritance tax. So lots of you may know already that currently there's a 100% inheritance tax exemption for eligible business property, and that's where the qualifying conditions are met. There's a raft of those, and I don't intend to go through them all today, but the business relief does include relief for unquoted shares in trading companies and also unincorporated businesses like family trading partnerships. So the big announcement in the budget was that full relief that exists at the moment will be restricted from April 2026. So for assets passing after that time, the full relief will be capped at £1 million value of the business. An inheritance tax on value above that £1 million will be at 50% of the main rate of inheritance tax. So what does that mean? At the moment, we've got a 40% inheritance tax rate on death. So for family businesses worth more than £1 million, or for value passing more than £1 million, 50% of that tax rate will apply. So 20% tax will be payable. Now, this is huge for family businesses who will need to consider how a charge for passing businesses down the generations is going to be managed, and indeed how it's going to be funded. There could be some very significant sums of tax involved here. Now, I should say there's still a lot of details still to come out. There's a paper expected in the new year on the application of the rules, particularly to family trust arrangements. And also we'll expect to see draft legislation in due course. But in the meantime, we've been talking to clients about passing on shares sooner rather than later. There's a phrase in the office about a gift with a warm hand, not a cold hand, which always makes me wince a little, but, you know, Sylvia's laughing. You can see the fun chat we have at Moore Kingston Smith. Lifetime gifting strategies is something to be thinking about in your family and with your family business. And also not just gifting, but also diversifying family share ownership, because every individual will have this £1 million allowance. And so there's a saving of £200,000 tax for every additional family member that holds business. So in the most simple example, where dad might hold the shares in the family company, passing some shares to mum, where that business is worth more than £1 million, and we've already achieved a 200,000 saving. So there's things to think about at the simple level and at the more complex level. Absolutely. Apart from gifting, another strategy may be to create a new class of growth shares in the family business. So growth shares, which are also sometimes known as freezer shares, are a mechanism to give away future value in the business while protecting the value that's already been built up by the existing shareholders. So the shares work by putting a current valuation on the business and then saying for any increase above that value, that's going to accrue into the growth shares. So we've essentially put a cap on the value of the business that attributes to the existing shares, and then the new growth shares will have the benefit of the value as it grows. So issuing growth shares to younger generations can be a great way to put a cap on or a lid maybe, on the increasing inheritance tax problem as the share values grow above that £1 million threshold. And because growth shares can be issued at a low value now, as they only have the hope, the dream that the business will grow in the future, that can make them very tax efficient. Because a big problem for lots of families is, how do we pass on the business now? How do we manage the tax charges today? And if you're a trading business, yes, okay, great. There can be reliefs that can help, and very happy to talk about those in more detail. But growth shares can also be very useful for managing family investment businesses and how you pass on that value. So although investment businesses aren't affected by these inheritance tax changes because we don't have the business relief for investments, it's still going to be the same sort of issues. How do we pass on the family business, and how are we going to manage the shift between the generations? Another strategy that you might consider is the use of family trusts. Now, I mentioned that we expect a consultation paper early in the new year, and this will set out more fully the proposal for how the inheritance tax changes will apply to family trust arrangements. Now, if you're familiar with trusts, or maybe you've heard one of our webinars before where Guy especially has talked us through some of the taxation of trusts, you'll know, or you'll remember, that there is a 10-year inheritance tax charge for a discretionary trust. So every 10 years, there's a 6% charge, get my numbers in the right order. And that's based on the value of the assets in the trust. Now, where those assets qualify for the business relief, at the moment, we've got 100% relief from that inheritance tax charge. But with the changes that we expect from April 26, that relief we expect to be restricted. So at the moment, where there might be a 0% inheritance tax for holding family trading company shares in trust, from April 26, that will no longer be the case. So there is a lot of commentary out there at the moment, which assumes that every trust will have its own £1 million allowance and pay half of the trust inheritance tax rate every 10 years. So rather than 6%, that would be 3%. I mean, hopefully that will be the case. As a 3% charge every 10 years, I mean, it sounds a bit more palatable, I think, to clients, to family businesses, rather than having a 20% charge for outright gifts outside of trust. And maybe 3% is a bit easier to fund and organise how you're going to pay for that tax. But really, we need to wait for this HMRC paper next year to look at the detail. So until we've got that, which I hope will be early in the new year, I don't recommend that clients transfer any assets into trust before then. We really need to understand exactly how these reliefs are going to work in the future before we tie assets up in trust. So watch this space, I think. It often seems to be the answer with tax, doesn't it? But absolutely, this is one to watch. So So something else that I want to mention is about employee ownership trusts. These could be a really interesting tool for family business, but absolutely won't suit everyone. There's a lot of talk about employee ownership trusts, also sometimes known as the John Lewis model, you know, where everybody is an owner of a little bit of the business. And it doesn't need to be a business as big as John Lewis. You know, family businesses of all sizes have looked at employee ownership trusts. And they can be a good answer in some circumstances, but as I say, I don't think they're for everybody. So just to cover a bit more of the detail, this planning requires that a special employee benefit trust is set up, and that trust will hold necessarily a controlling interest in the family company. So there are tax reliefs for shareholders in passing shares into an employee ownership trust. And there's also an exemption from the 10-year charge that I mentioned. So that's great in terms of the changes, because we won't need to worry about that 6% or 3% or whatever it may be when we see the detail. But there is a special requirement in the legislation that the shares held by the employee trust are managed for the benefit of all employees. And there's very strict rules around how employees may benefit with cash bonuses each year and so on. So for many clients that we talk to who perhaps are looking for family succession in the business, rather than to benefit everybody who works for the business, then I think an employee ownership trust may be one to pass up on. And I know for lots of clients, to pass value, particularly to children or other people in the next generation, that is really important. But where there isn't anybody in the next generation to take on the business, or you know, people perhaps who don't have children who they want to benefit, then an employee ownership trust is still a very viable option. And some of those tax reliefs for putting the shares in there are, you know, are great. So it's still one to talk about. Anyway, I've covered a few of the hot topics, I think, around the business relief changes. So Guy, what other tax issues do you think perhaps are worth covering today?
Thank you, Yvette. Hello, everyone. It's a pleasure to be here today. So there have been multiple areas that have taken up my time with clients since the budget. The Chancellor, Rachel Reeves, said that some parts of society would need to do the heavy lifting in helping to bridge the gap in the government's finances. And disappointingly, it seems that much of this has fallen on the shoulders of business, and small businesses in particular. So headlines for the changes include the hike in employers' national insurance contributions, the lowering of the threshold for when employers' NI applies, and increasing the national minimum wage. All of these measures separately increase the costs of business and collectively will have a huge impact, and certainly is coming into discussions that I'm having with clients. So what is it that clients can do and small businesses can do? Well, the double whammy of changes to national insurance is payable by businesses, and it's arguable whether this does or doesn't break a pre-election pledge not to increase taxes on working people, depending on what your definition of a working person is. It's not only increasing the headline rate from 13.8% to 15%, but also reducing the level at which employers' national insurance starts to be paid for employees when their earnings exceed £5,000 from April 2025. Previously, this was £9,100. And so this will lead to an increase of national insurance of £615 per employee who is paid more than £9,100 per year. Additionally, it will increase the amount of employers' NI pay by more than 8.5% on all salaries paid over £9,100. So it is the understatement of the year to say this is going to be a significant increase in business national insurance costs from 6th of April next year. Now, the impact on individual businesses will depend on their employee profile. So does take into account how many part-time workers, the number of employees, and the average salary level. And paradoxically, those businesses that have a large proportion of employees that work part-time could be the hardest hit. due to the halving of the level at which employers' national insurance starts to be payable. The employer allowance is being doubled to £10,500, and so this is the first part of the employer's national insurance that doesn't have to be paid, but this will be quickly eaten up by other national insurance increases for all businesses except for the very smallest. The challenge of facing small business in the past the challenge facing small businesses is the best way to approach this additional national insurance burden that is fast approaching. Neither of the two main levers they have of either wage or recruitment freezes are palatable. And each of these while they will conserve cash in the short term, could create longer term challenges to the profitability of the business as it becomes harder to retain and recruit talent. So what can businesses be looking at to make additional savings? Well, one key area, and I know this is an area that Rob will talk about in detail, is salary exchange. And this is where an employee exchanges part of their salary or bonus for an employer's pension contribution. And this will prevent a national insurance charge on the income exchanged. However, where this has been done historically, some employers have topped up the pension contribution by the employer's NI on the amount of income foregone. And the wording of these agreements will need to be revisited to identify if employers still have an obligation to continue to top up at the new rates. And there are other factors to consider for both higher and lower earners. An individual has an annual allowance that they can put in their pension contributions. And if they exceed this annual allowance, there is an excess contribution charge. The current limit that an individual can put into their pension scheme is £60,000. However, this is restricted where their adjusted income exceeds £260,000 per year and could actually be as low as £10,000. And exceeding the annual allowance will lead to a pensions tax charge. Looking at lower earners, the exchange of regular salary reduces an individual's income for tax purposes. But this also has the benefit of saving tax and NI at source. But it does mean a lower income level for mortgage application purposes. And we are finding that a lower income can create challenges for clients getting on or moving up the property ladder. So in the happy situation where there are excess profits within a well-run business, the big question is, should owner-managers draw these out as dividends or as a bonus? There are several moving parts that have changed and are changing, which impact the tax dynamic on profit extraction. So if we look through a few of these changes, these have included increases to dividend tax rates. You may recall the social care levy, which was introduced in 2023. I think that's about 3 or 4 prime ministers ago. This added 1.25% to employers' national insurance and to the tax rates on all dividends. While the national insurance increase was scrapped after just a few months, the increase on dividends was not. The employees' national insurance rate was reduced over the last 12 months, both in the last tax year and in the current tax year, while the employer's rate is increasing from next year. Finally, a bonus is allowable for corporation tax purposes, and these rates have also increased this year, while a dividend is not. So the tax position is very complex. But the overall position is that currently it is generally more tax efficient to take a bonus rather than a dividend. And this is expected to continue when the rules change on the increased employers' national insurance. But other factors need to be considered on what a person's income tax level is. And we need to look at that where there are various thresholds. So first of all, we have the higher rate tax that applies from £50,270. And this also impacts the available savings allowance. And we're finding clients having more interest where interest rates have gone up in previous years. and are finding that they're now having to pay an awful lot of tax on their savings. For families with children, we have the high income child benefit charge, and that applies to income between 60,000 to 80,000. And once income exceeds £80,000 in a tax year, then all of the child benefit has to be repaid. There's a personal allowance restriction when an individual's income exceeds £100,000, and this is restricted to zero once their income reaches £125,140. And then finally, we have the additional rate band, which applies to income above £125,140. And this again affects the available savings allowance, reducing it to nil. So again, increasing the amount of tax that's payable on bank interest. Now, some of these bandings are cliff edges, which can create tax rates over 100% where the limit is exceeded by £1, while others are gradually reduced as income crosses the threshold, but can still lead to marginal tax rates that are more than 50%. And it's easy to get to 62% or even 70 or 80%. So these are serious sort of increases in tax for clients. And so part of that is then looking at how shares are shared across family members of a business to make sure that all the appropriate reliefs and cliff edges are taken into account. And clearly, there is no one size fits all, and is more important than ever to plan based on each individual family member's personal circumstances. As already mentioned, there is a third option of employer pension contributions, which has the benefit of being an allowable deduction for corporation tax purposes. And it should not be forgotten that while the annual allowance can be restricted, there is relief for any unused annual contributions from the 3 previous tax years. And so these also need to be taken into account when considering the level of contribution that can be made in a tax year. So the last part I want to cover is inheritance tax, which Yvette covered in quite a lot of detail. And so there is going to be a little bit of overlap. I mean, the key area that I want to focus is slightly different. So first of all, we have the introduction of inheritance tax on pensions. And this has trailed quite heavily leading into the budget, less so when Labour first came into power, but certainly in the weeks leading up to the budget, there were more and more things appearing in the press. I remember the good old days when you had budget purdah and nothing appeared in the press, but the things have changed. So the announcement of inheritance tax being payable on pensions is going to have a huge impact. But it was not a huge surprise. But it has led to a fundamental rethink by clients on whether they should be looking at drawing down on pensions earlier than previously considered. And again, I'm at risk of treading on Rob's toes, and I'm sure he'll go into a lot more detail as to what's the best way and which assets to draw first. But certainly, these are the discussions that we're having with clients. And aside from the tax payable on pension pots when an individual dies, that there are risks of additional administrative difficulties in dealing with pension trustees as part of the probate process. And while I understand things are not getting worse with probate applications, there's been a lot of anecdotal evidence of delays in getting probate approved, and the executors are unable to pay the inheritance tax till they have access to the bank accounts, and the inheritance tax is payable 6 months after the date an individual dies. And this will become a bigger and bigger issue in the future. And as Yvette mentioned, the introduction of the £1 million inheritance tax allowance for business owners, replacing the unlimited relief, will have a significant impact. And this is where the challenge comes in, as Yvette mentioned, on putting assets into trust, is that we are having discussions with clients on that, because at the moment there is no entry charge for business relief assets passing into the trust. However, after 5th of April 2026, assets over £1 million, there will be an entry charge into the trust. But while there are a lot of tax reliefs for putting assets into a trust, there can be tax within them, and getting assets out of trust can be quite expensive as well. So rushing into a trust is probably not the best thing, but certainly it's one of the avenues to explore for clients as we approach 5th of April 2026. So I think that's probably enough on tax for the time being. And I think it's not how much you earn, it's how much you keep. So if I can pass across to Rob.
Thanks, Guy. Thanks for the introduction. Yeah, today I'm going to talk about sort of 3 or 4 different areas. I'm going to talk about pensions and put a bit more detail on what Guy was talking about regarding the change in how they're brought into the estate for HT purposes. I'm going to talk a little bit within the pension world about different pensions, self-invested pensions, and also small self-administered schemes, which a lot of smaller businesses use. So we're going to talk about different options with life assurance to pay the inheritance tax bill. And then lastly, I'm going to talk about different investment options, different products you can use to try and reduce your inheritance tax bill or pass on your assets tax efficiently. So let's start with pensions. Since, I suppose, 2015, when pension freedoms came into force, for most of our clients with significant assets in pensions, we've spoken to them about leaving the money in a pension, akin to it being a tax efficient trust. And that's because there was no tax when you're in the pension and no tax when you pass it down to your beneficiaries. It was outside the scope of inheritance tax. However, that's all changed, or will do, in April 2027. As with the trust planning, there's a consultation, and this is more about how the inheritance tax is paid from the pension companies to the exchequer. So our wealthier individuals do have a little window till April 27, but the way to avoid inheritance tax by expiry is not so attractive. So with this change, it means that pension funds will be bought into the estate. And so they've gone from really us saying for the last 9 years that keep the money in the pension, spend your savings first in retirement, and then access your pension last. That's changing now. And as Guy touched on, we're looking at ways you can accelerate the drawdown of income or assets for your pension. Now, when you have a pension, say you're lucky enough to have £1 million in your pension pot, what you can do, you can take a quarter of that generally as tax-free cash. And you need to take this pension commencement lump sum. Before the budget, we would have said, okay, well, you could take it before age 75 because any amounts in your pension on death were passed down to your beneficiaries tax-free as a lump sum or taken as income. But post 75, the beneficiary will pay their marginal rate of tax when they draw income out of that pension. But since the changes in the budget, because it's brought into the IHT scope, there's a potential of after 75 that the pension is passed down to the beneficiary, and there'll be a 40% charge when it's passed down. And when the beneficiary takes the money out, there could be another tax charge as well at their marginal rate, leading to around about a 67% tax charge for a higher rate taxpayer. So what we're looking at is a bit of use it, don't lose it, to try and accelerate taking income from your pension pot, and especially the tax-free cash before age 75. Now, when you're taking the tax-free cash, there's no point in taking it and putting it in a bank.
You a little bit sometimes. Rob, just if you could go back to that last little bit. I think we lost your connection a little bit. Well, I certainly did.
Okay, yeah, I think we've got some low bandwidth here. Yes, I was talking about taking tax-free cash before age 75. So we're encouraging clients now to take the tax-free cash before age 75. And when you take that tax-free cash, which is a quarter of your pension fund, the idea is either perhaps to gift it or spend it. If you leave it in a bank account or leave it in your estate, it's the same as leaving it in the pension fund. And as I explained earlier, by leaving it in after age 75, the beneficiary will not only pay inheritance tax, but also their marginal rate of tax taking it out. So this has meant we're going to accelerate drawdown within pensions. So that's taking money out of your pensions. As Guy mentioned with the tax rates, you could take this out, and we're going to encourage clients to take this up to their personal allowance, 12,570, up to around about 50,000 and pay 20% tax on it, or even as high as 100,000 and pay 40% tax on it. That will get some money out of the pension fund, de-risk it a bit in terms of it remaining in the estate, and also allow you then to gift it. And there's a couple of ways you can gift it to beneficiaries as a lump sum, or what we're encouraging clients, if they don't spend all of their income, they may be eligible to make a gift out of normal expenditure or surplus income. So say a client gets about £100,000 in income and spends 50, there's some money there spare, which they can gift to their children or grandchildren, and that gift then will fall out of their estate immediately. It's important they keep very good records of this. We encourage them to upload spreadsheets to our portal if they're so inclined. But it's important they keep a record of this so that when they do apply for probate, they have all the information for the revenue, so these gifts will be outside the estate. And then when the children get this money, they can use it. They could use it maybe, or the grandchildren for JISAs, junior ISAs for the grandchildren. You may be able to use it for school fees, but it's generally a good way of passing money out. So the takeout for this is look to access your pension earlier, and money you take out, look to use it. Great if you've got the lifestyle to spend it on yourself. If you haven't, then gift it down to your children if you think they deserve it. And just lastly, when talking about this and gifting money away, it's a bit like lending your children money. You know, a loan to a child is a gift. It's not a loan, because you're not going to get it back. So clients really need to make sure they retain sufficient funds for their own care in future. I've frozen again there. I was going to say the last thing we want is for clients to run out of money and be reliant on their children to pay their care, especially with...
There, Rob. I wanted to make sure everyone heard that.
Okay, thanks. Right, okay, so that's so hopefully that just covers sort of pensions and what you can do before and after 2027. Okay, but within the pension world, for a lot of smaller businesses and family companies, especially when they have property within their business, I'm talking about commercial property, so that might be their offices, might be a warehouse, whatever else. Often within a pension scheme, and that would be a self-invested personal pension or a small self-administered scheme, there's commercial property that's held within the pension scheme. So bought by the pension scheme or bought in conjunction with finance by the pension scheme. And that's a very efficient way of building up your pension pot, because not only your contributions in the pension scheme are used effectively for your business, but that property will pay a rent at a commercial rate back to the pension scheme. So that's really good for building up an amount of money and benefits within the pension. But the issue we have now, and we've always had really with this, if too much of the assets, so say you've got 10 million, say we're a really successful company, you've got 10 million in your pension pot for the family or for the business, and then 7 million of that is commercial property. That's great to have that in there, but when you come to want to take benefits out, what are you going to do with the property? The company may have enough money to buy the property back from the pension scheme, but if not, we need a strategy for taking that money out. And property is always an illiquid asset. So what we need then are liquid assets in this pension fund that is often, as I said, for the family business. Now, within these businesses, family businesses, there may be children employed by the business. And what often happens is the people that built up the business, the parents and maybe grandparents, they've invested heavily in pensions because they've been so tax efficient. That pension might build property, and there's a lot of money in the scheme. So part of the strategy will be look to make the scheme more liquid, but also the other part is that the children start making contributions into the company pension scheme, the family pension scheme, to build up an amount. That
we've lost you again, Rob.
Sorry about this.
Could you repeat that last sentence? Sorry, Rob, we lost you again.
That's okay, yeah. Within these company type pension arrangements for small businesses, what often happens is children come into the business and don't always participate in the pension scheme. And what we advise is that children start to utilise their annual allowance, £60,000, or carry forward from previous years if they've been paid enough money. So the company makes a contribution, they start building up an amount of earmarked funds, I suppose, within the scheme. This will enable the assets to be passed on more tax efficiently. And also there's a case for looking, and this is a sort of complicated pen area, for defined benefit SSASs. So a defined benefit stats, pensions are never easy, but what that means is that the members in the scheme can pay themselves a scheme pension potentially, and then the children that come into the scheme can build up assets quicker. They can sometimes double the amount of money they can put in each year. And also after the scheme pension, so this is like a final salary scheme where you get an amount paid for the rest of your life, unlike a money purchase scheme where there's a pension fund, you choose how and when you spend it. Any excess assets can then be passed to the children. So this area has to be fleshed out a bit, but it could be worth thinking about if you have a large sum in your family pension scheme. Otherwise, as with the other schemes, it's important to try and get the money out at some stage. It's great building up those contributions, but get the money out so you can spend it. Okay, so hopefully that covers pensions. So say you can't get all the money out of your pension. You either don't have the lifestyle or you don't want to pay all the tax. You will still have a tax bill then, an inheritance tax bill when you die. So what can be used to pay that? Well, what we're doing here, we're going back another 20 years again to a simple option. The simplest, purest option to do this is with a whole of life policy. And that really does what it says on the tin. You take out a plan and it can be reviewed every 5 years in terms of cost, or 10 years, or can be guaranteed a premium for the rest of your life. Things to consider here is the premiums are lower when you're younger and get more expensive as you get older. But this creates certainty, and it can be quite expensive, but it allows you to take out a life insurance policy for the payment of inheritance tax, and that can be placed in trust outside of your estate. Does two things: make sure the proceeds of the policy aren't subject to inheritance tax, and also, as Guy was saying about probate, it enables the beneficiaries to pay the tax quicker within the 6 months because it's passed directly on. So that's a really good way of ensuring you can pay the tax bill. Another policy that is eligible for employees of the company, including directors, is called a relevant life policy. This is a term assurance plan, and it's arranged and paid for by the company for a key employee or director who is classed as an employee. And now the good thing about this sort of policy is that premiums are very tax efficient.
Lost you again, Rob. Just the beginning of that sentence. Sorry.
I'm not doing well here. So yeah, with relevant life policy, the policy is designed specifically for sort of business owners or directors of businesses and their employees. And it's a really tax efficient type of policy. The premiums for the plan are allowable as a deduction as a business expense. And then the proceeds of the plan, again, can be placed in a trust, a relevant life policy trust, and that can go to the employee or the director's family or beneficiaries. And that, again, is very tax efficient outside the scope of inheritance tax. The downside of this is that it's a term assurance policy. So you might take it out. Probably the upper age for these is age 80. So it will enable you to plan for inheritance tax sort of in the short and medium term, but doesn't have the belt and braces cover that you get with the whole of life plan. So there are two different options that you want to consider to pay the tax bill. And I suppose the other part, as I said at the start, is looking at different investments. So alternatives to pensions, I would say. Now, pensions are still a great way of building up retirement income. Linking on what Guy said, you can pay employer premiums. You can effectively put £60,000 in a year and get tax relief on those monies, and then it grows tax-free and you pay tax when you take it out. But the alternatives to pensions, if either you earn in excess of £260,000 or £360,000 and that can only put £10,000 into a pension, is to look maybe at ISAs. And ISAs, if you're building up a pot or have a pot already, will be like gold dust because you can pay money into the ISA. You won't get tax relief going in, but you won't pay tax on the growth or taking money out. So again, they'll run alongside pensions in terms of taking out income. And there's other investments outside of that. So venture capital trusts, you can put up to £230. It's a tax reducer, and you can take your dividends tax-free. So that's a great way, if you're tapered on pensions, to build up another amount. And then also for those who have the appropriate appetite for risk, there's enterprise investment schemes. Now, these get up to 50% tax relief. You can hold over CGT or defer this CGT with capital gains tax within them. However, there's a large element of risk. These are unquoted companies, often sort of startup type businesses. So that's really only for those who, as I say, are quite speculative and have that capacity for loss. Finally, I'll have a look at two other aspects. And this is so when somebody comes to me and they want to invest a lump sum and they've used up all their other allowances on pensions or other assets, then again, we're going back to the future. Like most things in life, especially at my age, trend comes back. I don't know if the Beatles have come back or flares, but what's coming back is investment bonds. So investment bonds are a life assurance product, or they're based on life assurance legislation, and they allow you to invest in a bond. There used to be sort of a lot of restrictions on these bonds. There's less now, either onshore or offshore. And when you put money in this bond, the bond is taxed, especially with an onshore bond, is taxed at about 16% overall, or up to 20% within the bond. However, it's a really good thing for people to put money in, especially when they're higher rate taxpayers, because there's no other tax to pay when you take it out. Now, the wheeze with the inheritance tax planning is you can invest in these bonds and wrap this bond up in a discounted gift trust or in a loan trust. Now, in a discounted gift trust, trying to keep it fairly simple, when you put your money in when you wrap this around an investment, it could be an investment bond or not, what happens is you get a discount depending on how healthy you are and how young you are. The healthier you are and the younger you are, the bigger the discount. Again, since inheritance tax, immediately you put your investment in this bond. So you put £200,000 in, you might get a 30% reduction. So that'll be £60,000 out of your estate straight away. And the £140,000 will stay in. But then if you leave that in here in the bond and you live at least 7 years and it's within the nil rate band of £325,000, that amount will then fall outside of your estate. And especially the growth in the bond on a discounted gift trust. And a loan trust is all about the growth. I'll park that there at the moment. With a discounted gift trust, it just means to say you can also take a return of capital for 20 years. So you can take income out of the bond. That's the advantage. And then, as I said, whatever's left in the bond after 7 years will go to a class of beneficiaries, which are often your children or grandchildren. So these products are within scope for inheritance tax planning now, and they're probably used in addition to pensions and ISAs. So I hope that helps. Now back to Sylvia.
Yeah, thank you, Rob. I'm sorry about your technical problems that you had.
Okay.
That's life, isn't it? Well, thank you to all the panelists, and you've given us such a lot to think about, and I think there is a lot to unpick there. And starting people to sort of lay out the plans for the future. Whilst you've been speaking, I've been scribbling down some of the questions that are coming in. We've got actually quite a few questions, so I'm going to try and get through as many as I possibly can by squishing them together a little bit into sort of themed areas. I'm going to, yes, we've got a little bit of time, so we'll be okay. So the first question is about gifting of shares. So I'm amalgamating a couple of questions here. So one person has said, my father gifted shares in the family company last year. What will happen when he dies, if he dies, after April 2026? So we know April 26 is a cut-off point. Will I have to pay IHT? So when I think IHT, I think Yvette. Is this when you... Well, it's better than something. So somebody's had some shares gifted to them, assuming that the parent continues to survive after April 26. What's actually going to happen around that?
Yeah, thank you, Sylvia. Thank you. Well, as with any gift, there's a few different scenarios around the time for lifetime gifting and death. So lots of people listening will know, I'm sure, that for any outright gift in lifetime, the gift is potentially exempt at the time it's made, and it becomes fully exempt after 7 years. So if this, the person who's posed this question if the father survives 7 years, then the gift will be inheritance tax free. And if he doesn't, and the shares are eligible business property, then we've got business relief to consider where all those conditions are met. So the specific question, if the gift was before the 30th of October this year, and the father dies after April 26, so when we have the new rules in, I've confused myself. If the father dies, I'm sorry, I was going to say before April 26, Sylvia's face, we don't want to die too soon, I know, but if he does die sooner,
Interesting, didn't it?
I was going to say, then they'll have the full current unlimited exemption. So where those business relief conditions are met, we would expect those shares to be exempt from inheritance tax.
So that's the old rules, basically, because they did it before the budget.
Exactly, that's right, yeah. So if the gift's after the 30th of October, and the death is before the April 26, so quite a short window between gift and death, then again, we'd expect the old rules to apply, and we'd be looking at the full exemption. But where the gift's made after the 30th of October and the death is after April 26, then that's what we've got to think about the new rules. So, gosh, it is complicated. And I think with my stumble, I've made it even more complicated. But another thing I think is worth mentioning is really the valuations and how minority discounts work when we're thinking about share valuations. So it's definitely worth getting some advice and thinking about how the different scenarios might permeate through and the sums that might be involved, because especially where we don't have a controlling holding of shares that's been gifted, then the effect of a minority discount on the valuation can be quite marked and make quite a difference to the tax that's ultimately due. So there we are. I hope that helps anyway. I hope that helps.
It is a really complicated area, isn't it?
It's complicated, yeah.
And I'm quite a simple creature, Yvette. No, well, all of them know I'm quite simple. So I think if it's before the budget day, you've got old rules applying. If somebody dies before the April 26, if it's after budget day, you're into the new rules anyway, aren't you? I think.
Unless you die before April 26, yeah.
Unless you die to it, yes, okay.
So an early death is welcome, but
Well, you tax people talk about death and taxes far too freely. I don't know what to say, but I think that your point is to take advice on it, because
absolutely.
It is really, and those can be big sums of money that you're really talking about. And I think up until the budget, a lot of us felt that we were really simply comfortable that we understood where inheritance tax was going to land. There'd be some nuances, but as I say, that's one of the biggest impacts, I think. So I'll carry on because I'm not adding to the sum of human knowledge. Rob, I think this one is for you. So I've brought together, I think, this one. So Rob, AIM ISAs have been used to mitigate IHT, I think that's what the question was, by investing in unquoted companies on the alternative investment markets. That's AIM. What impact will the budget changes have on these plans? This is around AIM, so that sort of alternative market.
Yeah, that's correct, Sylvia. That's the alternative investment market. Yeah. And prior again to 2026, when the changes are coming in, clients were able to invest in these companies on the alternative investment market. It should be said, a bit like I was talking about with the EIS, these companies are larger than those companies. Their companies have been going a while, but they are quite volatile in terms of their sort of share price and their value. So if you invest in these companies, for investing in these companies, British companies, you were able to achieve a sort of 100% exemption on the amount you invested in terms of business relief. As part of the budget now, this is being cut to 50% from April 2026. So you got for taking a risk, I suppose, with this investment, you've got a pretty good exemption from inheritance tax without having to give the asset away. Now, with the changes coming in April 2026, these are looking less attractive. You're paying a premium in terms of risk for less relief. So what can you do about these? Well, we've been looking at this, and what you can do, you can look again to use business relief, but to perhaps change these assets that you've invested in AIM ISAs into another business relief scheme, an inheritance tax scheme. This scheme is again invested in an unquoted company, and it has to be a trading company, but it probably has a bit less, I suppose, volatility as opposed to an AIM investment. And you can switch these over. One thing to note is if you've made money in the AIM market, and consider after Liz Truss, a lot of people lost over 30% in the AIM market, then you would pay capital gains tax. But if you haven't made so much money, when you change these over, the clock you've acquired so far, so if you invested a year ago, you retain that year. So you don't have to switch into an inheritance tax scheme and start the clock for 2 years before it's outside of your estate. So that's worth considering. Take some advice again, as with a vet.
Excellent. It's very complicated though, isn't it? It's all about recognising the problem and then, well, you've got the answers, or the very good experts. I'm not even going to try and summarise that one because that was so complicated. I'm a very simple person. Right, I think I've got one for Guy. I haven't forgotten you, Guy. I put this together. Right, so someone is looking at succession planning, and we have that a lot with family businesses. And they say, what are the panel's thoughts? So I'm going to start with you though, Guy, on whether it is better to make lifetime gifts, as Yvette said, warm hand, is it? Or to pass them under a will. And that used to be very different advice, didn't it? You had a lot more freedom. But so have you got some thoughts on that, Guy? So succession planning, should we be doing it now, or thinking about now, or just waiting?
Well, that's a very good question. Thank you, Sylvia. I mean, sadly, as so often happens in tax, it depends. What I will say is the most important thing is make sure that you have a valid will in place and it's revisited on a regular basis. So the changes announced in the budget, and as we've been said several times, they affect from April 2026. Certainly mean now, so the family conversations, we're coming to a festive period, families are getting together. So sitting around the fire and just talking through what's been happening in 2024, it's having those difficult conversations, which there never seems to be quite the time to actually have. This year, more important than ever, have those conversations. And it's not just have this conversation once, it's an ongoing dynamic thing. So, I mean, there is scope to give business assets now and prevent an immediate charge to capital gains tax and inheritance tax. And as Yvette mentioned, this will start the 7-year clock running. And so one of those things, none of us is getting any younger. And so the sooner you start that 7-year clock running, the better. And once after the 7 years, it's outside an individual's estate. Now, if the transfer dies after 5th of April, 2026 and before 7 years have elapsed from the date of the gift, again, as Yvette mentioned, there could be an IHT charge on death. While that no one is happy with that, it should be a lower tax charge than doing nothing. So this is the conversation. There isn't a definitive answer, but look at the value of the estate, look at the family, look at the family members involved in the business. And it's one of those things where if you're already planning to make the transfer to the next generation, if you're having those discussions, then it is actually do it as early as possible is probably the best advice. But it's about looking, do you want to give outright? Do you want to put into a trust? And this where the rules can change. We had a consultation on trusts. Goodness, I'm sure Yvette will correct me here. It's probably 4 or 5 years ago. Where the 7 years was going to be put out to 10 or dropped to 5, and the 6% could be increased to 10% or dropped to 4%. Who knows? I mean, until we've got some visibility on that, it's always a risk on going ahead. But that doesn't stop you from planning now and thinking about it. And so, what else can we think about that? Well, doing nothing is a perfectly valid decision, but it needs to be a decision. It needs to be an active decision. It needs to be to say, well, I don't think the family are ready for take on the business, or actually the family aren't interested in taking on the business. There will be, I've got some key people in the management team. And as Yvette mentioned, maybe the employee ownership trust is the way forward. So it's, doing nothing and waiting and holding on to the assets until you pass away, there's nothing wrong with doing that. But it needs to be an outcome based on a positive decision rather than outcome of not thinking about it or discussing it within the family.
Absolutely. And I think it all starts with strategy for what do we want for the family, what do we want for the next generation, what do we want for my generation, that sort of thing. I think I'm sort of laughing because, around the Christmas table, whilst you're having turkey, talking about death and taxes probably isn't what people are going to do. But actually talking about strategy, first of all, because I think a lot of this sometimes gets left quite late. And the one thing that I've heard, and I've been scribbling down a few notes of the things that you said, is about planning in advance. It can never hurt to have an idea of what the paradigm is that you want. Now, you might not be able to get to it exactly, but one thing we know with the budget is it's quite complicated. It's got lots of nuances and things have been brought in that are different from the expectation that we had before. So yeah, you're right. Do nothing if that's a decision, but doing nothing because you didn't know what to do, I think, is a very different one. And I think in terms of summarising, I've got lots of questions, but they're all different ones. So what I'm going to say is, just as a quick takeaways, I think, Yvette, what I heard you saying on inheritance tax, big changes coming in, almost inevitable that any estate of any reasonable size is going to be impacted. There's things to think about. Trusts might be a good idea to add in, but let's not jump into that straight away. There's some devil coming out in the detail, I think, of Rachel's announcements, and that's coming out next year. And I'm quite sure you're going to be back on this channel talking to us about some of the things that are being pulled out. I know. Guy said, I liked what you said, Guy, which was it's changed a little bit, the nuance of this. It's from it's gone from how much you earn and have to a bit more about how much can you keep and hold on to. I think there's a lot of changes. There's a lot of tripwires, I think, in national insurance and pension contributions and people. And I just think it's about reviewing plans. You may not change them, but at least you don't change them from a point of knowledge. I think everybody needs to do that. I think, Rob, apart from your point about flares, I think they are back, actually. I think the wild leg is back, just so you know. But you said gift it or spend it. Well, the bit I heard was spend it, actually.
Best inheritance tax planning there is, Sylvia. Spend it.
I'm liking it. I'm thinking about it right now. But I like the second point was about taking some instructions, looking at pensions slightly differently now. And the insurances point, I think, is sometimes forgotten, that if you can't avoid some tax, then take some of the pain, the sting out of it when it actually arrives in a variety of things. And you gave us a whole load of letters from ISAs and VCTs and EISs and DGTs. So really complicated. And we know pensions and all the advisory side is really difficult, but there are some solutions there. They might be a bit different from what you would have advised previously. It's sort of evolved slightly, I think. And what was that? Bonds onshore and offshore. And it got very complicated at that point. What I heard was you need somebody who knows what they're doing with it, I think, is probably where we are. So I'm going, in 2 minutes, I will say that I think we've run out of time. We do have quite a number of individual questions, and our panelists will email everybody with the answers afterwards. So please, just because we haven't pulled those into this, don't think that we're going to forget you. I hope that you found today's webinar useful, even if you found it slightly overwhelming. There's a lot to think about, and I think it's about starting that thought process. Over the Christmas dinner, great idea. You can throw in
Sylvia,
those acronyms, and people will think you're very. Sorry, have I cut out?
We lost you for a moment.
We lost you for a second.
Okay, I probably wasn't saying anything. Okay, I was going to say, starting over the Christmas dinner, starting the conversation with some of these ideas, people will think you're very intelligent if you throw in some of those acronyms from Rob. But my point is, do start to think about things. And if you want to have a look at any of this, there's lots more on our webpage on the Moore Kingston Smith website. Have a look for family business. You'll see all of the people on this screen now, plus lots more of our experts that cover all sorts of areas. So do go on there. There's lots of insights, podcasts, details, and they'll be updated as things progress, which they will do, I think, Yvette was telling us in the new year. So we're going to have a lot more coming out. You can actually talk to real people. There'll be emails and phone numbers on there as well, so you can get in touch with us. And a copy of this webinar, if you can bear to watch us all again, but a copy of this webinar will be up on there very shortly so that you can have a look, and we'll be sending it out to various people. 2025 will be the new year, and we will be starting a new series. I have no doubt that it will include lots about tax and pensions and all sorts of strategic thinking for families and businesses. But I'm going to stop now because we're actually at our end of time, and all that remains for me is to say thank you to our panel, to Guy, Yvette and Rob. Thank you so much. And thank you all to you for joining us today. And I hope that you have a lovely break over the Christmas period, and we'll see you all again in the new year. Thank you.
Great. Thank you very much.
Bye-bye.
Thank you so